Hi, this is Keith Schneider, CEO of MarketGauge.com, and this week's edition of Market Outlook. It is April 7th, 2012. So, if you like this video and you like Market Outlook, please be sure to go to the website if you haven't signed up already to get this email to you every week. Or you can even get this on YouTube and join us over there. So, with this week's action, lots of changes from the Fed, some fundamental shifts. We have a lot to talk about. First of all, we had a down week in most of the indexes. As you can see, by the way, this is a resource that is free on the Market Gauge website. It is the Little Big View. And as you can see this week, the diamonds were down, or the Dow was down 1.1%. Russell, which has been having trouble and really churning for the last almost 2 months, only up about 1.5, down 1.5%. Nasdaq mostly up, marginally because of the action in Apple. Also to take note on this page is we have accumulation and distribution, which is looking at volume and price action together. And if you have an up day on greater than normal volume from the prior day, then you have an accumulation day, and the reverse is true. One thing you can see is that the Russells and the S&P 500 clearly having 4 distribution days in the last 2 weeks, so lots of sideways action. And some distributions showing up, not nearly as pronounced in the diamonds or the Nasdaq. Now let's take a look at the charts, because we had some fundamental shifts with the Fed saying that potentially the no QE3 and in fact rates rose for much of the weekend, certainly dramatically rose with the initial response. So let's take a look at the chart of the S&P. Take note, the overall chart in the S&P still in a strongly bullish phase. You can see this 50-day, this blue line here, sharply rising. The 200-day moving average still up. We're neither overbought nor oversold. However, you can see that the distribution days, these red bars here, definitely took place while the market basically went sideways over the last 2 weeks. Now, also to take note is that we are trading under the 10-day moving average and basically had almost, I'm pretty sure that might have been close to an inside day on Thursday. So we definitely want to watch here and see, are we going to be under further pressure? Now, taking a look at the weekly chart, there are some interesting patterns here. For one, from the low in 2009, you have this trend line, which also coincides with a test of the trend line from this rally right here. So you can see this is a very, very strong trend line. It also was basically the channel that created this up move here, or that contained the up move. And over here, with the price action that you saw on the daily chart, we've been bumping up against a sort of a return move to that channel line, and it's been pausing. Now, with a couple more weeks of pause potentially, or some sideways action, you could actually develop enough compression to power out to the upside of the channel. Conversely, the trend that's been in effect since the October lows has contained the whole move up. So you've got a very, very valid trend line starting from the low here. As you continue to make new highs, we have these tests along the way, which makes that a valid trend line. A series of higher highs and higher lows makes for a valid trend based on trend theory and Dow theory. So right now we have this situation where the sideways action in the market is still being contained by this trend line. The trend is still intact, but a break of this trend would be significant. This would be the first time it's broken since the low that was put in October 4th. Okay, now let's move on to sentiment. Sentiment. The VIX indicator, as you can see, has been basically trading down, consistent with the bull market. Not too much fear in the market. With the sell-off, moved up a little bit this week. The low in the VIX was somewhere around 13.5 or so percent. We're still trading within the Bollinger Band, but it's compressing very, very sharply. And you can see that the channel lines from the low, from these lows here, all the way to the point where we had the panic in August, the top of the channel, you can see we're being contained within this trading range, and then even a little bit more of a compressed trading range. So what we're going to look for here is a move above that 50-day moving average, which is basically where it closed, and the Bollinger Band. It may be, if it just moves sideways and doesn't really dramatically get a pop, it's sort of not the most powerful signal, but nonetheless, the trend line in the VIX from the October lows in the market being tested here. But we really need to see a move, power out move here to see that sentiment has shifted. So will the pressure of higher rates and potentially not as much money being poured into the market as had been put the kibosh on this rally or not? Obviously, the sentiment is going to help tell the story. Let's keep an eye on this here. Meanwhile, we're still trading in a very, very positive tone overall. And this overall trend, downtrend, still intact. Moving on to the market internals, the McClellan oscillator, which incorporates the intermediate term reading, has shown remarkable strength in the market, or revealed remarkable strength, as you can see, where we've been able to work off overbought readings by going actually up, and it's also reacted extremely positively to any oversold readings below this basic level in here on the chart. And as you can see, even though we've sort of just gone sideways, we've actually hit some a slightly oversold reading, which is positive for the market. Let's see if that materializes into a rally here or continues down. But nonetheless, you can see that these readings at this level right here have resulted in some pretty good rallies, and the market has shown remarkable resilience, even in the fact that the tone oftentimes has been what would be normally considered a bit overbought, and in fact the market just continued higher. On the shorter term time frames, the 10-day advanced decline, 10-day up-down volume, we're sort of in no man's land, so not much of a reading there. Let's take a look at TLTs. You can see TLTs interest rates are really a key component here to watch. So, you know, as market moves through different themes, you want to focus on the most important theme. As you can see, the tilts TLT are the 20-year bonds. They have been under pressure. We talked about this sell-off a couple of weeks ago, meaning a rise in rates, and that this was a sea change, and all of this up here is resistance. Now, when the Fed announced this week that there was not going to be further easing, or alluded to it, you can see that the market sold off. So indeed, we had that oversold reading. Rates got a little bit too strong. We corrected, but we still see this as critical resistance. This trend line right here, also very important, coincides with the 50-day moving average. We really don't want to see it move above here. The market should find a level of resistance around the 115 to 115.50 level. Now, one point is that we've had 2 inside days to the big down move, so that's sort of interesting. It'll be very, very important reading to see how we power out of this 3-day pattern right here. But overall, this market should hit resistance. If the market is indicating that there's a shift, that the Fed is really going to stick to what it alluded to this week, then we should not move above this trend line here, and certainly the resistance comes in right around this 115.50 to 116 level. Now, looking at the bigger picture on the weekly charts, similar play out. You can see that the trend line here coincides with that trend line that I just showed you on the daily charts, and you can see that the body of the work that was done on the weekly candles come in a little bit higher, more around the 116 level. Now, that doesn't mean you can't peak above this level, but true resistance should really be hitting around here if this is indeed a turning point in the market, based on the fact that the Fed is not going to continue to ease. So, the other thing I want to cover is gold. And one thing I often like to do is use the gold miners and see what they're doing. And you can see that the gold mining index on a weekly basis has been topping, along with some pressure in the gold market. But this clearly has been rolling over. Gold miners never nearly perform as good as gold in a bull market, but often lead in telling when the bull market may end. In this case, you can see that we have this head and shoulders pattern here on the weekly chart that we broke down with conviction this week. So, in terms of the overall market, the S&P, what I also want to do is just take a look at the S&P 500 on a half-hour basis, because I think you're going to need this level of detail to help you guide through next week's price action. You can see we had a trend line here. This is a half-hour chart. Don't get too confused by the labeling, because we use this in the live trading room, and we usually zoom up on it. But nonetheless, you can see that the price action since mid-March has been contained by this upwardly rising channel. You drop a parallel, and you can see that the market's been contained in this trading channel. So this week, especially towards the later part of the week, when the Fed announced it was not going to continue with easing as much as it had, the market sold off. But more importantly, it tried Thursday morning to take out the bottom of the channel, and using our half-hour rule, it never penetrated and sort of held. So right now, looking at the way the market's set up, you can see we're under the 10-day moving average. We're trading at the bottom part of this channel. It's fairly important that we hold the lows from Thursday, which would also and also the first half hour of the trading day on Monday, and any day that we potentially break through the bottom of this channel. So this is your critical point. Now, on the other hand, this could have been just a pause, which would be a healthy sign for the market. Initial reaction, sell-off to potential rising rates, contained within the existing channel. So this could be positive. You can see we started moving a little bit outside of this accelerated downtrend line here. This coincides with the bottom of the channel, so it's possible that we're going to accelerate and get a test of that 142.50 to 143 level. So let's keep an eye on this particular channel and how everything is playing out in the various global macro picture, including the rates, which we showed you the key levels, also in gold, which is obviously extremely interest rate sensitive. let's we looked at the gold miners, but let's take a look at the gold itself, GLD, and you can see in GLD we have a pretty interesting channel. Once we got the news that the market was not going to get any more free money, gold immediately tanked, then followed through with a huge gap down and interesting bounce and a close. But you can see, again, we're trading under the 200-day moving average, the 50-day starting to roll over. We're playing within this channel. If gold really has now entered a new intermediate term correction phase for real, we really shouldn't be penetrating the top of this trend line, the 200-day moving average, and this high of the red candle from Tuesday. Okay, well, that wraps it up for now, and have a great holiday weekend, and look forward to seeing you next week. Thanks, and be sure to find us on YouTube and our website, and don't forget to sign up if you like this video, to sign up for this newsletter to get it on a weekly basis.